Hello friends, welcome to Learn Easy. We will discuss interest rates in macroeconomics. Interest rates provide important signals about the direction of the economy and future growth trends. Adjustments to rates by central bank, that is Reserve Bank of India, like lowering or raising the policy rate, aim to influence borrowing behavior and overall economic activity. Let us discuss different types of interest rates. Interest rate for cost of borrowing and interest rate of return on saving. Base rate is the interest rate which the central bank, that is RBI, lends money to the commercial banks. Commercial banks are free to set their own interest rates in saving account, current account, mortgage loan, unsecured loan and credit card. But it tends to be strongly influenced by the central bank base rate. If they find it more expensive to borrow from the central bank, they tend to increase their commercial rates. The real interest rate is nominal interest rate minus inflation. As for example, if interest rates are 5% and the inflation rate 3%, the real interest rate is 2%. It means savers will see the increase in the value of their savings despite inflation of 3%. The key factors that influence interest rates relevant to the stock markets are inflation, central bank monetary policy, economic growth, and credit risk. Factors that influence interest rates. First, supply and demand. Supply and demand refers to the interaction between the supply of money available to lend and the demand to borrow money. Second, inflation. Inflation refers to the rate of increase in the general price level of goods and services in an economy. As inflation rises, the purchasing power of a currency falls. This dynamic directly impacts interest rates and the stock market. High inflation typically spurs interest rates hikes, while low inflation leads to rate cuts. Third, government policy. Lower rates incentivize borrowing and increase money supply. Higher rates discourage borrowing and drain liquidity from the system. Fourth, taxes. Taxes refers to compulsory financial charges imposed by governments on income, consumption, properties and transactions. Tax regimes and rates significantly impact interest rates and capital flows within an economy. Fifth, banks. Higher reserves and capital buffers reduce the amount banks sometimes lend out. During robust economic growth, banks lower standards to expand credit. The increased loan supply dampens rates. But in troubled economies, banks tighten standards and issue less credit, pushing rates higher. Risk premiums also rise and fall based on banks' default outlooks. Sixth, economy. The overall state of the economy profoundly impacts interest rates through the demand and supply of capital as well as inflation expectations. Robust economic growth fuels demand for credit, pushing rates higher, while recession see rates fall as demand declines. Seventh, Fiscal policy. Fiscal policy impacts interest rates through its effects on budget deficits, national debt levels, inflation expectations, and capital flows between asset classes. 8. Monetary policy. Monetary policy refers to central bank actions aimed to controlling money supply, credit conditions, and interest rates. 9th. Credit risk. Credit risk refers to the probability of default on debt obligations by borrowers. As perceptions of credit risk increase, lenders demand higher interest rates to compensate for the heightened chance of missed payments or outright defaults. The degree of credit risk in an economy significantly impacts interest rates. If you find the topic interesting and helpful, do subscribe my channel and press the notification bell. Benefits from interest rates effect on inflation. First, stabilizing tool. The government can use interest rate effect on currency and borrowing to stabilize the economy. For example, suppose the economy is overheating. The interest rates are raised and the interest rates are reduced when the economy slows down. It tends to then act as a stabilizing tool for the economy. Second, tool for monetarists. Interest rate tends to be favorite tool for monetarists. The interest rate effect tends to move the economy towards the desired direction of any country's central bank. Monetarists tend to believe that if the economy is expanding rapidly, the interest rates can serve as a tool to remove money from circulation by raising interest rates. Third, boost for exports. The interest rate effect through a reduction in interest rates devalue the local currency, significantly boosting country exports. There are certain disadvantages of the interest rate effect on inflation. First, time lag. Even if the interest rate changes have been taken, it does require a significant amount of time for the interest rate effect to be visible in the economy. As a result, the impact of changes may take months or even sometimes years to even reflect and even materialize. Second, affect the whole economy, including the untargeted sector. It is also well known that the monetary policy tool being interest rate cannot be targeted to solve problems of a single sector or even boost a specific industry or region. Third, technical limitations. If the interest rates are kept low for a relatively long period, it may often lead to a liquidity trap for the country. Fourth, reduction in asset prices. An increase in interest rate would reduce the valuation of financial assets like stocks and bonds. Fifth, possible risk of hyperinflation. When money is pumped into the economy, it may cause out of control inflation that leads to hyperinflation brought about by the low interest rate environment. By reducing the cost of credit, lower rates encourage consumption, investment, and domestic demand. However, higher rates have the reverse effect of restraining growth by making financing more expensive. Higher interest rates have various economic effects. First, increases the cost of borrowing. With higher interest rates, interest payments on credit card and loans are more expensive. This discourages people from borrowing and spending. Second, increase in mortgage interest payments. If the interest payments on variable mortgage increases, then it will have a significant impact on consumer spending. Third, increased incentive to save rather than spend. Higher interest rate make it more attractive to save in a deposit account because of the interest rate gained. Fourth, higher interest rates increase the value of currency. Higher interest rates makes export less competitive, reducing exports and increasing imports. This has the effect of reducing aggregate demand in the economy. Fifth, rising interest rates affect both consumers and firms. The economy is likely to experience falls in consumption and investment. Sixth, government debt interest payments increase. Higher interest rates increase the cost of government interest payments. This could lead to higher taxes in the future. Seventh, reduced confidence. Interest rates affect consumer and business confidence. A rise in interest rate discourages investment. It makes firms and consumers less willing to make risky investment and purchases. Now, let us discuss zero interest rate policy. Zero interest rate policy refers to monetary policy where a central bank sets its target short-term nominal interest rates at or close to zero. The goal is to help boost economic growth during periods of stagnation or recession. By making the cost of borrowing nearly free, a zero rate policy aims to incentivize lending and spending to stimulate aggregate demand. A few countries like Switzerland, Denmark, and Japan adopted negative interest rate to fight deflation and encourage spending. As of today, some of these countries have increased their interest rate to meager amount of below 1%. That's all for today. Thank you for watching the video.